In this next section, we're going to have a quick overview of the 3 trading sessions that we have looked at throughout this course, and we're also going to look at some of the smaller nuances that can take place within each of the sessions. So up until now, you've learnt that each of the sessions generally have their own unique purpose within the Smart Money business plan, but the order of execution may change depending on market forces. And you'd learnt that primarily the Asian session is where the accumulation of retail orders will take place. The London session is where the manipulation and the unfolding of the daily trend will take place. And then finally, during the US session, we're generally going to see the New York reversal. So on your charts, the Asian range is represented by a grey box, and this grey box will help you to identify the Asian range. Now, the box will typically begin to unfold at the start of each trading day, and we set this to midnight GMT. Okay, so the beginning of the Asian range and the grey box should be set to begin painting at the beginning of the trading day, which is 12 o'clock GMT. Now, the box will stop printing just before the start of the London session. Okay, so from 12 midnight GMT to 7 AM GMT, we have the beginning and also the end of our Asian range, and our grey box will help us to highlight this and allow us to identify and also interpret the stop run and the manipulation of orders. So as we know, the Asian range is where smart money will generally accumulate the position for the current trading day. Now, the price range in the session is usually tight and less volatile and offers very little opportunities to trade. So there are traders that will trade the actual Asian session, but because of the range, the risk reward is generally very hard to gain. It's generally not a volatile session, so in terms of the returns that you will receive, they will be very minimal. There are exceptions to this rule, obviously depending on the climate of the market and holidays in other regions of the world, but typically the Asian session isn't one that we recommend trading. The better opportunities definitely come about during the London and also the New York session. Now, one of the nuances with the Asian range is that the price at some point will tend to test the mid-levels of the New York session. Okay, so the high or the low of the current day's Asian session will tend to test the mid of the prior day's New York session. It will generally act as a visible support and resistance line. So in this first example, if I mark out the high to low range of the prior day's US session, and we mark out the high of the current day's trading session, we can see that the high has tested the mid of the prior day's US trend. Okay, because if we measure the distance between the high of the previous day's US high and low, we get a range of 13.8, so we say about 14 if we round it up. And if we move the cursor and we put it in line with the high of the Asian range, we can see that we are 7.5 pips into the range. So a very common occurrence, and it's something that you would see on a day-to-day basis. If I delete the current day's high and we move on to the following day, and again I'm going to mark out the low to the high of the US session, and then we're going to mark out the current day's Asian low. And again, if I measure the low to high range of the prior US session, we have a 21 pip range. And then if I measure from the low to the high, we have a 9-point range. So again, in and around the mid of the prior day's US session. And this is something that you will see in the majority of time frames and also the majority of the pairs. So again, if I mark out the high to the low of the prior day's US session, mark out the current day's low, and we measure the range, we have a 21 pip range from the high to low of the prior session. And if I align it with the current day's Asian low, we have a 10.7 range. So very common that you will see this. It's a invisible support and resistance level. Many times you will have very obvious candlestick formations that will form around this level. In this example, we can see that we have an evening star formation which has formed mid of the range. But again, this is something you will see in all markets and also all time frames. Okay, so in regards to the Asian range, we've also learned that the tight range and low liquidity that occurs during the Asian range attracts support and resistance traders, many of which will place orders on both sides of the high and the low. And we've seen many examples of the breakout opportunities and also the obvious stop loss placement areas that occur during this tight range, which happens at the beginning of the trading day. And smart money will watch these areas so they can induce traders into the wrong side of the market, set off stops, and also absorb the orders of those breakout traders. So the tight range of the Asian session creates a great opportunity for support and resistance traders to place pending orders on either side of the high and low, but also is a targeted area where smart money will use to manipulate those retail traders out of the market. Now, in regards to trading the Asian range, as I said before, and as mentioned above, because the tight range and low liquidity that occurs, the opportunities that present themselves are generally poor, and the return that you will get in relation to the risk is generally to the downside, simply because the market doesn't move. We always want to trade a market that moves, and a market where we have a realistic opportunity to meet our risk to reward ratio. So in regards to trading the Asian range, if you feel compelled or you fancy having a shot at trading the tight range in the session, the best opportunity to trade the Asian range is when the session price is pushed into the previous day's high or low. Okay, and we're simply going to treat that as a manipulation area that we have identified, and many times you will see that during the Asian range they will push prices into this region, and then if you see the correct candlestick formation or your moving average cross or the combination of both take place and you're in line with the smart money trend, then you can pull the trigger and you can trade the end of the range. I mean, sometimes the range will be larger than others depending on the market climate and also what's going on in terms of economics and other contributing factors. But in terms of your best opportunity, it's definitely going to be when price is pushed into the previous day's high or low. Now, it is our recommendation that the trading of the Asian range should only be considered once you have mastered both the US and the European sessions. Okay, so this is an important point in terms of the stop runs that occur just before the London session. Now, many times a stop run may occur just before the European Open, and it is essential that the stop run is confirmed by the London session traders to be valid. So if you've marked off or identified a potential area of deep liquidity and you see a stop run So we see the stop run candle, which is the breaking of the level by 3 points. But this occurs just before the European session. The confirmation candle must take place during the London session for the stop run to be valid. So if you see the stop runs of a identified level at say 6:30, and at 6:45 we get a confirmation candle to the downside, but they both take place within the Asian session, the stop run will not count. The confirmation candle needs to take place during the London session. In this first example, we're looking at the euro dollar, and I've identified a potential area for manipulation, which is the previous day's US high. Now, in the current day's trading, as the Asian session comes to an end, we can see that they perform a stop run of the Asian highs, and we can see that it's broken by 3 points. The next candle gives us a higher low, so it becomes our new stop run candle, and then we get confirmation to the downside, which closes within its lower 1/3 region. Now, the stop run and the confirmation have both occurred during the Asian session. Okay, ideally we want the confirmation to occur during the London session. So if we see the stop run happen just prior to the London Open, our preference is that we see the confirmation during the London Open. And in this session we don't get an immediate confirmation, but the market returns back to the manipulation level and performs the same function. We get a lower high, and then we get a confirmation candle to the downside, which in effect is our classic M formation. Okay, so the level identified showed a stop run towards the end of the Asian session, but we received the confirmation during the Asian session, so this will invalidate the stop run, and then we see the second leg of the M formation produce a evening star formation, which is a reversal candlestick formation, and will therefore validate the original stop run. In this next example, we're looking at the sterling against the dollar, where again we have a stop run of not only the Asian lows but also a prime manipulation area, and the stop run occurs just before the open of the London session. Now, in this example, we receive the confirmation candle on the open of the London session, therefore validating the Asian stop run. Okay, so the London traders have seen the stop run of the Asian session and they've confirmed, so we can be sure that the trend is going to be in line with the current cycle, and we're going to see our move to the upside. So as long as the confirmation takes place during the London session, then the stop run that's taken place prior to the open will be valid. And last but not least, in regards to the Asian session, and that is during times of US and UK bank holidays or high interest news events such as interest rate decisions or non-farm payroll, the accumulation process may occur during a different session. Okay, so depending on the factors surrounding the market at the time, an example of this is non-farm payroll, which is a massive news event within the US session. The accumulation process, you will often see, will take place during the London session as the smart money and the big institutions begin to accumulate their position in anticipation for the big move. Now, it's been said that many of these institutions know the news events before they come out. Whether this is true or not is open to debate, but generally, if you can work out the accumulation and the manipulation of retail orders prior to the news event coming out, you will very often find that you will trade in line with whatever the news event is. And news events is something that we will most probably add to the course at a later date. We will be adding parts to this course as we go along, and the questions and the queries that you may have we will answer. And if we get many on the same subject, we'll simply put another section together. So yes, the accumulation process can often take place in other sessions. So once the Asian session has come to an end and smart money have accumulated the majority of their position for the trading day, we enter into the busiest and most liquid session of the trading day, which is the European or London session. So the London session is the most active and where the initial manipulation of retail orders and the day's trend will most often take place. And we've seen numerous examples throughout the course where we've seen the induction and then the manipulation of retail orders, and then we've seen the trend unfold in terms of the intraday, where we see 3 legs to the up or to the down side. Now, identifying where you are within the smart money trend will help you to project the next move, and this is essential if we want to trade in line with the smart money trend. And we saw in our section on the cycles that if you can understand and interpret where you are in the higher degree weekly cycle, it will allow you to identify manipulation areas and finally trade intraday in line with the smart money trend. So the identification of the weekly cycle is essential to allow you to identify deep pools of liquidity and then interpret manipulation at these levels, and then finally pull the trigger in line with the smart money trend. Now, this session is where we will look for stop runs at identified levels, again, which are in line with the daily smart money trend. And we'll be looking for our candlestick formations and also our classic M and W formations in and around the areas that we have identified. Now, in terms of guidelines for where the typical stop hunt will take place during the London session, the stop run will most often occur at the Asian high or low, or 25 to 50 pips above or below the Asian high or low. So in terms of the process for identifying our levels, we're simply going to mark off the most obvious that we've been taught and that you saw during the section on identifying manipulation levels. But as a guideline, we'll typically start with the Asian high or low and look for manipulation around this area. And if we don't get the stop run or the M and W formation around this level, you'll typically look for identified areas which are 25 to 50 pips above or below the Asian high or low. And this is obviously whether you're looking to trade long or short. Now, on the chart, the 25 to 50 pips stop run area is represented by the 2 boxes which are either side of the Japanese session. And you may have noticed these empty boxes throughout the course, and they're simply marking the 25 to 50 pip region above or below the Asian session. So on this euro dollar chart, we can see that we have 2 boxes which sit either side of the Asian high and low, and all these boxes represent is the range of 25 to 50 pips above or below the session. Okay, so if I click on our measuring tool and I click from the Asian high and measure to the first line in the box, we have 25 pips. If I measure that to the second line, it simply measures 50 pips. And the boxes are dynamic as the Asian range is printing and the high and low range change. The distance of the boxes will also. Okay, so they're high probability areas. In recent times, we're generally seeing the manipulation take place just above or below the Asian range, but markets do change and they generally revert to the norm, and we would generally see a 25 to 50 pip manipulation area. In saying that, this is just a guideline. Never look for these areas for manipulation. Simply identify your areas first, and then you're going to be looking for the relevant candlestick patterns or formations to take place at these areas. One quick thing to note is as of recent times, we generally get the New York reversal in and around 25 to 50 pips from the high or the low. So if you notice, the boxes are in line with the New York reversals. Now, another guideline and tool that we can use when identifying areas of potential deep liquidity is if the current level of the smart money trend is unclear or confusing, the use of currency correlation can help to assist in your trade entry decision. And we saw, especially in examples where the market is in level 3 accumulation, where there is no clear trend to the market and we have no directional bias, and we're trying to either trade both sides of the level or identify phase 1, that through the use of correlation we can reinforce and also confirm a trade entry decision. And remember, the candlestick and M&W formations are what we typically use during these sessions to identify and interpret the stop hunt. Okay, so currency correlation is a great tool in times where you may be a little bit confused as to your directional bias or the smart money trend, and you're looking to make a trade entry decision, but you want that extra bit of reinforcement. And we saw in our section where we looked at trade entry that you can apply the moving average cross to your candlestick formations or M&W formations for extra confirmation of the trade, and currency correlation is then the icing on the cake or the final tool to confirm your decision. Now, there's one final guideline in regards to the European session, and it relates to trade entry. Now, the fact that manipulation most often takes place at the beginning and the end of a trading session, no trade should be entered 45 minutes before the New York Open. Okay, so no trades should be entered 45 minutes before the New York Open. Any open positions should be closed or at least set to break even 45 minutes before the New York Open. And this is because you would generally find the major manipulation of retail orders will generally take place at the beginnings and also the ends. Now, what I mean by that is that manipulation will generally take place at the beginning of the week and also the end of the week, at the beginning of the day and the end of the day, and also the beginning of a trading session and the end of a trading session. So if you have an open position or you don't have an open position leading into the US session, you're going to be exposed to a possible stop hunt against your position. Okay, so if you haven't entered a trade within 45 minutes before the New York Open, then you will not be entering a trade. You'll be looking for manipulation to take place during the US session and then trade the New York reversal. If you already have a position, you'll be breaking even or taking the risk of entering into a possible reversal against the dominant trend. Okay, so it's a very simple guideline. It's one which comes with experience, but it's not set in stone. It's something we typically follow here at Trade Simple, Trade Smart, because once you've entered into a trade, you don't want that risk of giving back profits that you've accumulated through the New York reversal, or being stopped out by a major stop hunt. Okay, so once we've seen the accumulation of retail orders throughout the Asian session, and then we've identified our potential areas of deep liquidity, we've seen manipulation and then the trend unfold during the London session, we then enter into the US session. Now, during the US session, price action will most often behave in one of two ways. The first of which is a reversal of the day's trend, which we know by now is the New York reversal. Or alternatively, we're going to see the opposite, and we're going to see a continuation of the intraday trend. But first, we're going to take a look at some of the minor details and the smaller nuances of the New York reversal. So the New York reversal is a counter trend trade that occurs when price retraces back into the current day's trend. And we've seen many examples of the New York reversal where we see that price action changes direction and trades back into the range of the trend which unfold during the London session. Now, this trade would generally not offer as many pips as the London session, generally around 25 to 40 pips. So for those of you that trade the US session primarily, you're generally not going to get as many pips on the table as you do in the London session. And this is simply because the reversal is generally a midpoint retracement of the European session. So all that means, if we see a 80-point range between the low and high of the London session, the reversal or the New York reversal is generally going to be around 40 pips. Now, it's very common to see the New York reversal between the times of 1 and 3 o'clock GMT, or the first hours of the US session. Okay, so just bear that in mind if you are trading the New York session, or if you trade both, that we generally want to see the reversal take place within the first 3 hours of the session's open. So the reversal is likely to occur when the intraday trend is at phase 3, just prior to entering the US session. So we know that for both the weekly and also the intraday smart money trend, that it moves in 3 phases. Okay, on the weekly, where we have phase 1, 2, 3, we then have the period of accumulation and then a reversal of the trend, or we get that false push to the downside. With the intraday, we see 3 phases, and then we're going to expect the New York reversal to unfold once the London session has closed. Other indications of a possible New York reversal are when the high and low of the day have already formed prior to the open of the US session, and also the currency pair's average daily range being reached or exceeded as you enter into the session. So if you see that we have both a high and low form throughout the day, and this is combined with your 3 phases of rise or fall, this is a high indication that the New York reversal could take place on the open. In terms of the average daily range, if you have a currency pair with an average daily range of say 70, and before the New York open we see that the ADR is in and around the 68 to 75 mark, there's going to be a high probability that the New York session is going to reverse, because the average daily range of the pair has been met. Okay, so in terms of the probability of a reversal, you can use these individually, but if you see these in combination, it always increases the chance that a reversal will take place. Now, cross-currency correlation should and can be used to reinforce and add confirmation to a possible trade setup. So once we've entered the New York Open, you're going to be looking for prior areas of manipulation or identify areas of deep liquidity that smart money may choose to manipulate. And once you've done this, because of the nature of New York reversal, it'd always be good to have that extra bit of confirmation, whether this be with moving averages, but especially with currency correlation. So if you're trading the euro dollar, for example, and you see a stop hunt of a prime manipulation level or area of deep liquidity during the New York session, and this correlates with the sterling against the dollar, then your chances of a successful trade will be increased. And this is especially important with the New York session because the amount of pips on offer are not as great as the London session. Okay, so in this first example, we're looking at the sterling against the dollar, where over the last 30 days, we've had an average daily range of 64.9, which we've rounded up to 65. So one of the biggest signals that we may receive a New York reversal on the open of the session is if we've seen 3 levels of rise or fall during the intraday trend in the London session. So in this example, we have 3 levels of fall. We have our first level down and then a retracement, a second level down and then a minor retracement, and then we have a third level down. Now, to add reinforcement and to increase the probability of a reversal taking place, we will check to see if the ADR or the range of this downtrend is in and around the 65 mark, and then you can further confirm this if the high and the low of the day has been set. So if we take our measuring tool and we measure the range of the day, so we want to go in this case from the high of the Japanese session down to the low of the London session, we have an ADR or a range of 63.2. Okay, so we're only 1.8 points from meeting the ADR of the last 30 days. So we have 2 clear signals. We have 3 levels of fall to the downside, and we also have the range of the trend in and around the ADR or the average daily range for the last 30 days. Now in this example, we have the high of the day, which has been set during the Japanese session, and we have the low of the day, which has been set during the London session. So we have all 3 of the high probability signals come together. We have the high and low of the day being set prior to the open. We have 3 levels of fall, and we also have the market 1.8 points away from its average daily range. And then as we see, as the New York session opens, we get this reversal back into the range of the London trend. Okay, so again, this can be further reinforced through looking through correlation with the euro dollar. If we were to see a stop run or 3 levels of fall during the euro dollar session, this would also add confirmation that the New York reversal is highly probable. In terms of an uptrend, we'd use the exact same technique, but obviously in reverse. So in an uptrend, in this example, we have 3 levels of rise prior to the open of the New York session. Again, we have the ADR at 65. So we're going to check from the low to the high of the trading session. And in this case, at the open of the New York session, the high of the day, and the average daily range comes in at 69.1. So in this case, we've exceeded the average daily range. We have the low, which has been set during the London session, and then we have the high, which is represented by this hammer, an aggressive move to the downside set during the New York session. So again, we have all three of the high probability signals that the reversal is likely to take place, and then we have this aggressive reversal back into the range of the London session. So they are the three high probability signals to look out for, the strongest of which will be a combination of three levels of rise and fall, and also the average daily range for the market being met prior to the New York session opening. Okay, so very simple, very straightforward. For those of you that primarily trade the New York session, or for those of you who trade London and also were looking for opportunities during the US, then if you combine these three high probability signals together, this will filter your trade, and you should be in line for a good setup as long as you see manipulation at a level of prior support and resistance, and you can confirm again with the correlation of the euro dollar. Okay, so we know that the New York reversal isn't guaranteed, and that many times smart money will use the US session to continue the trend which is unfolded during the European session. But how do we know whether a reversal or a trend continuation is going to take place? Well, we've looked at the high probability signals that can indicate to us whether a reversal will take place, and in this section we're going to take a quick look at the signals which are the same that will let us know if a trend continuation is about to take place. So the New York trend continuation is most likely to occur when the intraday trend is not in the third phase. Okay, so in the previous example during the New York reversal, if the market had shown three levels of rise or three levels of fall prior to the open of the US session, there was a high degree of probability that a reversal was about to take place. Now, we know that the market will generally unfold in three phases or three legs. So if we see one or two legs take place prior to the US Open, we can generally expect the third to take place during the session in the direction of the unfolding trend. Okay, and if you think about it, it's just common sense. We're always going to expect three legs or three phases to the up and to the downside. So if we've only seen two legs to the upside, for example, and we're entering into the US session, we're going to expect our third to take place during the US session, which in effect is a trend continuation. The second high probability signal is the currency pair's average daily range has not been reached or exceeded by price action prior to entering the session. Okay, so it's the two same signals we use with the reversal, but we're just using them in different ways. So in terms of the trend continuation, we're looking for a trend which has not reached the third phase prior to the open of the US Open or the US session, and we're looking for the range of this trend to be short of the currency pair's ADR. Now, when the trend is set to continue during the New York session, a price retracement back into the range of the intraday trend will very often occur before the open of the session. Now, within this retracement, smart money will typically hit the stops before the continuation of the trend. Okay, so a great signal as to whether a trend continuation is going to take place is we see a reversal back into the range of the trend, and then we see a stop hunt or a M or W formation take place during the reversal. Okay, so we're looking for 3 high probability signals. We're looking for a trend which hasn't reached the 3rd phase of the intraday move. We're looking for this trend to be short of the market's average daily range, and we're going to be looking for a reversal prior to the open of the US session, which generally contains a stop hunt or M&W formation. And again, with both the New York reversal and also the trend continuation trades, correlation between the relevant pairs should be used to identify if the stop run or manipulation or formations are taking place or developing at the same time. And again, you're just going to use the relevant currency pairs. So if you're using sterling against the dollar, we're going to use the euro dollar. And obviously if we're using the sterling yen or euro yen, we're going to use the dollar yen and any other relevant pairs. In this first example, we're looking at the euro dollar, and again the high probability signals that a trend continuation is about to take place over a reversal during the US session is we want to see an intraday trend that has failed to make 3 levels of rise or fall. The range of this trend is below the ADR, and also the classic reversal that takes place just prior to the open back into the range of the trend, which is generally in the form of a stop hunt. So in this example, we have 2 levels of rise coming out of the Asian session, and then we get this reversal. Okay, now if you notice, this reversal is a classic W formation, and we know that the W formation is created to induce sellers into the market, which allows smart money to buy into, and in this case continue the trend. Okay, so we have again 2 levels of rise. We have an ADR of 56. So if we measure the low to high range of the 2 legs, this comes up to 48. Okay, so we're quite some ways below our average daily range, so we can tick our first box. We only have 2 levels of rise leading into the US Open, so we can tick our second box, and then we have a reversal just prior to the open in the form of a stop hunt formation, so we can tick our third. And then finally we see the last leg or the third leg within the trend, and if we measure the low to the high of the intraday trend, once it's complete, we can see that we're at a range of around 59.2, so we actually exceed the ADR. Okay, so again, simple and straightforward. We're simply using the same signals in a different way that we used for the reversal. We saw 2 levels of rise prior to the open of the US session, a reversal back into the range, which is a classic telltale sign, and in this case we had a stop hunt in the form of a W formation, and then the completion of the trend. In our second example, we're looking at the dollar versus the Swiss, and again we have the same scenario but in reverse. So out of the Asian session, we have a fall to the downside, and then we have a second, and then we get this reversal formation in the form of an ABCD or M, and the ADR for the 2 phases is a range of 27. Okay, so we have an ADR, average daily range, of 42, our 2 levels of fall out of Asia, only reached 27 pips. We see our reversal back into the range of the London session, which forms an M formation, and then we see the continuation of the trend during the US session. Now, I'm just going to point out, if I mark off this prior level of support and resistance, so we can see that we have 1, 2, 3 significant touches, and then the last leg of the M formation, or the ABCD, we see that smart money push prices through this level, induce buyers into the market, they sell into this and continue the trend. Okay, so you can look for the classic horizontal stop hunt to take place during the US session, but the classic reversal back into the range just prior to the open will always be your first telltale sign that a continuation is going to take place. And finally, we're looking at the euro against the sterling, where we have 2 levels of fall coming out of the Asian session. The range of the 2 legs to the downside is 34. We have an ADR of 41, so we know that we're short of the ADR. We then see that classic reversal prior to the open of the US session, and it's in the form of an ABC or an M formation, and then we see the continuation and the move to the downside. Okay, so it's something that you will begin to see automatically. The classic telltale sign, again, and I can't emphasize this enough, is the reversal that takes place prior to the open. But you need all 3 of the high probability signals to come together to increase the probability of a trade if you do decide to sell or buy into the market. But just always be mindful of correlation with a relevant currency pair to reinforce and confirm your decision. Okay, so we're now reaching the end of our course, and by now you've received the relevant information and tools that will allow you to trade in line with the Smart Money business plan and make money on a consistent basis. Now, the most important thing when learning and also applying this strategy to the currency markets is to keep it simple. By overcomplicating the process, you run the risk of reverting back to norm and falling into that 95% bracket. So the best way to keep it simple is throughout the trading day, and as each session unfolds, is to run through a series of questions that will keep you in line with the strategy that has been set out. So the first that we're going to look at is trend identification. So the most important thing when applying this strategy is that we want to be in line with the Smart Money weekly and also the intraday trend. So the first question, once you've pulled up a currency pair, is what and where is the Smart Money daily trend? And we know by now that we would look at the 1 hour chart, and we're going to look to identify whether we're in phase 1, phase 2, phase 3, or if we are in level 3 accumulation. And once we've identified exactly where we are in the daily trend, we're then going to move on to the 15-minute chart, where we're going to identify high probability levels of support and resistance and the confluence of technical tools that are in line with the identified trend. Okay, so 2 very simple processes. We're simply going to identify on any particular currency pair where we are in the longer term daily trend, and then we're going to use the knowledge that we received in our section on identify manipulation levels to identify high probability levels or deep pools of liquidity that are in line with the smart money daily trend. So during the London session, which is the primary session that we're going to be looking to trade, or the New York, the first thing we're going to ask ourselves is there a stop run at the end of the Asian session and the beginning of the London session? Okay, so once we see that accumulation take place where smart money are building their orders for the day, we're going to be looking for manipulation in and around the Asian session high or the Asian session low. The second question we're going to ask ourselves is, have smart money moved to the manipulation box, which is 25 to 50 pips outside of the Asian range, and created a M or W formation or stop run? Now, many times you will have identified levels that fall between the Asian session and also the manipulation box, and you'll be looking first and foremost at the levels that fall in between for the M formation or stop run. But just bear in mind that the manipulation box, or the 25 to 50 pip range outside of the Asian session, is a high probability place where you will often see the manipulation of retail orders and the beginning of the London session trend. Another question and another technical support level to look out for is, are the previous or current day's high or lows being tested? And we've seen in our examples that both the previous and also the current day's high and low are notorious for the M and W formation, because we generally have trap volume from the previous day in and around these levels, and we also have the induction of breakout traders once the level is broken. Now, if a stop run or formation is identified as a potential zone, is there correlation between the relevant pairs? And we saw that when you have two currency pairs that are very similar or correlated in their price movements, if we see a stop run within a relatively narrow time frame, or even at the exact time taking place at identified levels, then the probability of a successful trade will be increased. And on the execution of a trade, you have to remember that it is essential that entry is a maximum of 15 pips from the most recent high or low. And the reason we do this is because of typically the M and W formation, where the variations will often take out the first leg of the structure, and if you place your stop just above the first leg, you would generally get stopped out. So the 15 pip maximum rule is to ensure that we don't get manipulated and stopped out of the market if the second leg of the M and W formation takes out the most recently set high or low. Now, in regards to the London session, I did touch on this in previous, but if you do have an open position 45 minutes before the New York's open, the position should be closed or set to break even. And this is simply because we generally see the major manipulations of retail orders at the beginning and end. So as we enter into the last 45 minutes of the London session, we're generally going to see some kind of stop run during New York or just before New York. And if you have an open position, you run the risk of being stopped out or giving back unnecessary profits. Now, I do stress that this is only a guideline. Okay, there will be many times where you may catch, for example, phase 1 or phase 2 of the smart money weekly or daily trend. Okay, and in cases like this, you may wish to hold your intraday position for 1, 2 or even 3 days. Okay, so for example, if I manage to catch phase 1 out of level 3 accumulation, and I'm expecting 3 rises to the upside, and I may choose to hold the position for the next 3 days. Now, in times like this, I wouldn't be closing my position 45 minutes before the New York Open, because I have a longer term view on not only the weekly cycle but also the intraday. Okay, so it's only a guideline for intraday trading, but just be careful, because 45 minutes before the New York Open is notorious time for retracements and also stop runs. Okay, so as we enter the New York session, we're again going to ask ourselves a series of questions that will allow us to trade in line with the intraday continuation of the trend or the New York reversal. So the first question we're going to ask ourselves is, what phase of the intraday trend is the market? Have we seen 3 levels of rise or fall? And we know from this section that if we've seen 3 levels of rise or fall take place before the New York Open, then the probability of a New York reversal is greatly increased. Okay, and on the flip side, if we've only made, say, 2 phases or 2 levels of rise or fall prior to the Open, then the likelihood of a trend continuation is the most likely outcome. The next question we're going to ask is, has the trend reached or exceeded the pair's average daily range before the New York Open? And this is a question we use in combination with the 3 levels of rise or fall, because if we've seen 3 levels of rise and fall and the market has reached or exceeded the pair's average daily range, then again the combination of the two greatly increases the likelihood of the New York reversal. Another question to ask is, has there been a trend reversal and stop run just prior to the New York Open? Okay, so has there been a trend reversal and stop run just prior to the New York Open? And again, this question is used in combination with the 3 levels of rise or fall. If we've seen 2 levels of rise and then we see a trend reversal and stop run just prior to the Open, then the likelihood of a trend continuation is the most likely outcome. Next, if a stop run or formation is identified prior to or during the New York session, is there correlation between the relevant pairs? So whether we're looking for the trend continuation and the stop hunt that takes place during a retracement just prior to the Open, or whether we've seen 3 levels of rise or fall and we're looking for the New York reversal, once we have identified the stop run or the formation, we want to look for correlation between the market's relevant pair, and as we know, this will reinforce our trade entry decision. Now, in regards to trade entry, again, we're going to be executing the trade with a maximum of 15 pips from the most recent high or low, and as you know, this is because of the M&W formation. The pullback candle is great for getting in closer to the most recent high or low, but many times the confirmation candle will fall within this 15 pip maximum range. Now finally, the execution of trades and identification of high probability manipulation areas will vary with each trader. Okay, and this is generally down to the tools in which you use and apply to the charts of the Forex markets to identify your levels. We generally recommend that you use all of the tools that you have learnt for identifying high probability levels of deep liquidity, because this will bring together all of the schools of thoughts and the strategies and techniques generally used by retail traders into one focal point. Okay, and smart money will be doing the same. And when we see a confluence of these technical tools, it's a high probability area where the execution and the liquidation of smart money trades will take place. Now, a very important point is each trader must identify the currency pairs, the sessions, the manipulation areas and formations they are most comfortable and able to trade. Okay, and the best way to determine what's best for you when utilizing this strategy is to use a demo account. Okay, chart time and trial and error is a trader's best friend. Okay, not all of the sessions or the currency pairs or even the formations are best for everybody, and you will generally find that you will have a preference as to one over the other. Now, in regards to trade entry, you will never catch every opportunity that presents itself, and this is just the nature of trading. There will be many missed opportunities, but if you look through your currency pairs, you would generally find that an opportunity is just around the corner. So if the identification of the smart money trend, manipulation levels or stop run formations are unclear, do not force the trade. Okay, many times you will see in the forum or in our live videos that we have taken an opportunity and identified an area of manipulation and pulled the trigger, and you may not have seen the same thing. And this is just down to experience. If you don't understand certain elements of the strategy, then go over them in the course, ask questions in the forum, or ask questions during the live trading session. But the most important thing is to not force the trade unless you yourself have a full understanding as to why. Okay, and always remember that no position is a position. Okay, don't look for an excuse to trade, because trade opportunities will always be there. The most important thing is that you're trading with a purpose and that you understand fully as to why you have entered a position. So always keep in mind that this is the smart money business plan and it cannot change. Okay, trade opportunities will always present themselves over multiple currency pairs consistently over days, weeks and months. So we've established that the smart money business plan is the perfect tool to counteract the strategies and techniques and the schools of thought of 95% of retail traders. It's a strategy that allows them to execute and also liquidate positions at favorable prices to keep their costs down, and it will not change. Okay, so don't rush. If you don't understand anything, we're here to help you. The demo accounts, again, are a great tool to practice the strategy and to give yourself enough chart time so that you can see where manipulation takes place without even thinking. And that's the point that you want to get to, where you can open up a chart and at a glance, once you've identified your levels, you can determine whether the retail positions are being manipulated and smart money are about to unfold a trend that you can get in line with.